Every morning, 20% of the world's traded oil and huge volumes of natural gas sail through a 21-mile-wide stretch of water between Oman and Iran. For decades, the global economy operated on a quiet, shared assumption: the Strait of Hormuz would stay open. That assumption collapsed in early March 2026. Following coordinated U.S. and Israeli airstrikes on Iranian infrastructure, Iranian forces retaliated by physically choking off these narrow shipping lanes, stranding hundreds of commercial vessels. Initially, markets braced for a familiar scenario. Analysts expected the stranded crude to drive up global gas prices, echoing the petroleum panics of the 1970s. But the blockade stopped liquefied gas, froze shipments of industrial metals, and canceled 4,000 flights in a single afternoon. Closing this single critical point of transit immediately placed the world's most complex supply chains on an unsustainable, ticking countdown. The immediate damage struck the very nations hosting the blockade. The major transit hubs of the Middle East, including Dubai and Doha, saw their airspace closed and thousands of daily flights canceled, leaving sprawling terminals completely empty. Because these nations are located in arid desert climates, they import the vast majority of their caloric intake. With the shipping lanes shut down, 70% of the region's food imports simply stopped arriving, forcing grocery retailers to airlift basic staples at massive premiums. The isolation quickly extended to drinking water. Subsequent military strikes targeted the region's massive desalination plants, the specialized facilities responsible for 99% of the potable water in Qatar and Kuwait. In less than a week, the blockade rendered the world's wealthiest region a vulnerable humanitarian zone. 5,000 miles away, the sudden halt of Qatar's liquefied natural gas production exposed hidden, fragile dependencies across Asia. Countries like Japan, South Korea, and Taiwan rely heavily on these shipments, and with massive tankers floating idle, an entirely different sector began to fail. Liquefied natural gas extraction produces a highly specific byproduct, helium. Because it is chemically inert and reaches exceptionally low temperatures, helium is required to cool down silicon wafers during microchip manufacturing. Qatar alone refines 35% of the global helium supply. When that supply vanished behind the blockade, spot prices tripled, and semiconductor production stalled across Asia. The blockade trapped another critical export. The Gulf accounts for nearly half of all globally traded sulfur and vast amounts of urea, the primary chemical feedstocks used to manufacture agricultural fertilizer. With those shipments severed, the cost to produce nitrogen fertilizers doubled. Farmers heading into the spring planting season had to sharply reduce their usage, guaranteeing lower yields for staple crops like wheat and rice worldwide. By cutting off a single geographic node, the blockade managed to simultaneously throttle the global technology sector and starve the foundational agricultural supply chain. Moving westward, the shockwave collided with a European continent emerging from a harsh winter. Natural gas storage facilities sat at barely 30% capacity. The sudden disappearance of Middle Eastern LNG triggered an immediate energy crunch. Wholesale gas benchmarks practically doubled, forcing energy-intensive operations like chemical plants and steel manufacturers to impose massive surcharges. The United States had domestic oil production to buffer the worst of the physical shortages, but the reality is energy markets are globally linked. The panic over missing Middle Eastern barrels pushed U.S. gasoline prices past $4 a gallon by late March. This chart shows the macroeconomic trap facing global central banks. As energy and food shortages severely restrict economic growth, represented by the plummeting line, the scarcity of those exact same goods drives inflation rapidly upward. This state is known as stagflation. The world's most powerful economies were caught in a situation where standard monetary tools were rendered completely useless against a physical maritime blockade. Even if military operations pause and the ships eventually sail, the illusion of the Gulf as an insulated, permanently safe destination for global investment has been broken. The conflict triggered a massive demographic reversal. Highly skilled expatriates and business owners fled the region, pulling their families and their capital out of the Middle Eastern market. In India alone, over 220,000 nationals returned home in a matter of weeks. They largely bypassed the congested major metros, pouring their savings into secondary cities and driving a sudden 14% spike in local real estate markets. The 2026 war demonstrated the consequence of prioritizing razor-thin supply chain efficiency over basic geographic resilience. By tying everything to a single narrow shipping lane, the global economy built a machine so delicate that a missile strike in the Middle East directly dictates the cost of a microchip in Taiwan, a tomato in Brazil, and a mortgage in London.